Chapter 9 discusses cash, so cash within the company. All right, in this chapter, we're going to look at the different objectives, and those are going to be our cash receipts. And we're going to account for our cash that is short or over in our registers. We're going to be looking at petty cash and internal controls for cash. So we're going to demonstrate the procedures for a petty cash fund, how to establish a petty cash fund, and how to replenish the petty cash fund. Then we'll look at the internal controls for our cash in order to protect our cash. Then finally in section 3, we're going to look at banking procedures. That's how we're going to be writing our checks, endorsing checks, preparing bank deposit slips, and maintaining our checkbook balances. We'll reconcile a monthly bank statement, and we'll record adjusting entries that are going to be required from the bank reconciliation. Then we'll look at some of the online banking and managing cash activities that are offered to businesses by banks. And then finally, I always want to remind you to make sure you're going over your accounting terms in this chapter, and you'll find those terms on the outlines as well in the overview. So do understand all of the terms for your exams and for your quizzes. So what is cash? In accounting, the term cash is used for currency. Those are any dollar bills, $100 bills, $50 bills, whatever types of bills we have. Those are going to be your coins as well as checks. Checks are considered cash. We can take those to the bank and we can retrieve cash. Money orders, the same as checks. We can take those to the bank, or we could take it to some check cashing places as well and receive money. So those are all going to be considered cash. And those funds on deposit in the bank are going to be considered our cash, okay? Any deposits in the bank are considered cash as well. Any deposits in transit. So say you went and you made a deposit around 8 p.m. at night, that's going to be considered cash as well. And most likely that deposit would be clearing the bank the next morning. So there's two types of cash receipts, okay? The types of cash receipts are going to depend on the nature of the business, all right? And we must maintain an adequate cash flow because cash is what we're going to use to make our payments, all right? So we need to make sure we do have cash in our accounts or somewhere where we can make our payments, any expenses that we have incurred in the business. So supermarkets receive checks as well as currency and coins. And then you're going to have your department stores, they're going to receive checks or mail from charge of customer accounts. Okay, so in the mail, they'll receive those checks from those customers that use credit card. Then your wholesalers are usually going to receive cash in the form of checks as well. Okay, and we also have EFT transfers. So there's different ways of receiving your cash now. So occasionally there are going to be errors when we're making change. So now what we're doing is we're focusing towards the merchandising companies, okay? So say your Target. Usually if any of you have ever worked at a store, when you first come into work, before you start taking customers, you're going to count your drawer and you're going to know how much was in your drawer before you started taking customers, okay? And so occasionally there's going to be errors, okay? When you go to close down your register and you're getting off of work, you have to count your register again. All right. So the cash in the register is either more or less than the cash listed on the cash receipt tape. So if you think of a cash register, excuse me, if you think of a cash register, there's a tape you're giving a tape with your receipt, as well as there's tape that's staying inside of the register, okay, and it's being kept for reconciling issues, okay, and occasionally there will be a difference between what you counted and what the tape says, okay, and so we have to account for those cash short or cash over. All right, so when cash receipts are more than the sales as per the register tape, so when you've counted more in your register than your register tape says, then this is going to be considered cash over. Okay, and when your cash receipts are less, meaning you counted the register and there's less money than the register tape is saying, then you're going to be cash short. Okay, so whenever your register is less, you're cash short. Whenever your register is more, you're cash over. All right, and we're going to be accounting for that, and we're going to be recording journal entries to record those cash over or cash short entries so that our cash does reconcile. So how do we account for cash that is short or over? So cash tends to be short more often than over, right? Because customers are going to most likely tell you or complain if they receive too little change, right? Most times you pay and you know exactly how much change you're supposed to get back. So you're going to tell the cashier, you know what, this isn't all my change, right? And most honest people, if you did receive too much change, you would say, again, you would most likely tell them that, you know what, this is too much change. You gave me too much back. All right. But all of us aren't very honest. So cash tends to be short more often than over, just because of that fact. I mean, it's human instinct, basically. All right, so cash short or over amounts are recorded in the cash short or over account. So there's going to be an account and it's going to be called the cash short or over account. Okay, and if we credit this account, that means that there was an overage, and this is going to be treated as more revenue for us. So with the credit balance we're going to consider it an overage, a cash over. Similarly, if there's a debit balance in the account, there's a shortage, and that is going to be treated as an expense. Okay, so a debit to this cash short or over account is going to mean that our register was short, so we have an expense. Okay, moving along. So an example of cash short. Okay, cash short means our register doesn't show that it shows that we have less in our register compared to our register tape. Okay, so Royal Jewelry Store, a retail business, keeps $200 change fund, okay, in its register. So when I pick up my register, there's automatically going to be $200 of change in there. All right, it could be dollars, coins that is going to already be in my register. All right. Royal Jewelry starts business on September 29th. The cash sales per the cash register tape on September 29th were $2,200. So the cash tape in the register tells me that there's $2,200 in that register. But when I went to count it, it says the cash count was $23.97. The register was short by $3. All right. And this is calculated as followed. So first we have to take into account the $200 that is already in the cash register. Okay, so we're going to start with the cash count, what we counted in the register, which is the $23.97. All right, then we're going to take out that $200 that is always kept in the register as the change fund. Okay, then that brings us to our bank deposit, the amount that we've put into the register during the period of work of $2,197. All right, but our sales register tape says there should be $2,200 in there. So that means we're short $3. So we need to prepare a journal entry for that $3. Okay, and remember, short means there's an expense. All right, and that means we're going to debit our cash short or over. All right, so this next slide is going to show you that journal entry. All right, so we have cash on September 29th. We're going to debit our cash for what was in the register, the $21.97. Okay, and then we're going to debit our cash short or over for $3. All right, and that brings us to the register tape of 2,200. All right, and we're going to be crediting our sales. This is our revenue. We're going to use our sales account. We're going to be crediting our sales for $2,200. And that's going to complete our journal entry to record our sales for the period as well as to record the short, how much we were short in our register. So this is another example of cash over. Okay, we did cash short. Now we're going to look at cash over. And cash over means that we have more in our register than the register tape says we should have. So the cash sales per the cash register tape on September 30th were $2,100. Okay, so the register's tape says we have $2,100. When we counted the cash, there was actually $2,301. All right, so now we have to figure out how much the register was over. And we're going to calculate this by first taking our cash count, which is the 2,300. Okay, we're going to take our cash count. All right, then we're going to take out less the change fund. All right, and in this problem, it didn't really say the change fund, but I'm going to go ahead and add that. Okay, so our cash register is going to include a change fund of $200. All right, so then we take our less our change fund. So we're going to subtract out our change fund. All right, and that's going to give us the amount that our bank deposit would be for the day. And that's going to be the amount of sales or cash we collected for sales for that day. All right, and this is just, you're just doing the computation here. The $2,301 minus the $200 brings us to 2,101. Okay, and per our cash register tape here, it says our cash register tape on September 30 were 2,100. Okay, so we bring that 2,100 here. All right, and so now we're looking at the difference between the 2,101 and the 2,100, and the difference between the two is going to be $1. Okay, so that'll be our amount over, and that's what we would need to record a journal entry for. And so when we're recording our amount over, we need to credit the account, okay? And this is going to be revenue, and we're crediting it because revenue, in order to increase revenue, we need to credit it, okay? Our revenue is going to be our sales. Okay, so that's kind of how that problem works out. So now we'll go over to our journal and we're going to record the cash that was in our register, as well as we're going to record the amount that was over. So this is what that journal entry is going to look like. First, we're going to record the cash. It was 2,101. So that was the 2,301 minus the $200. Okay, so we went and we recorded the amount of the bank deposit. That's what we're going to be recording. Okay, and then in our sales, first off, in our cash short or over account, we're going to credit it because it was over for $100. Then we're going to go and credit our sales for $2,100. Okay, so that helps us to balance our debits equal our credits. And this is to record the sale and cash overage. Okay, so you can see how when it was over, we'd credit it. And if I go back to this journal entry, when it was short, we debit it. Okay. So on the general ledger, we have our cash short and our cash short or over. Okay, we're going to have an account for that. And this is what the ledger is going to look like. It'll show the debits and it'll show the credits, and we'll have a run on balance. All right. And so we're going to bring that over to our financial statement as well. And as we go through, I'll present this to you on the financial statement. You'll see how it's presented on the financial statement when we work through the step by step. All right, so here's another example, all right, of cash short and cash over. And it says Northwest Gift Shop, a retail business, started business on April 29th. It keeps $300 change fund in the register. Okay, so every time we're counting our register, we have to take into account this $300 change fund. All right. The cash registers for the cash receipts for the period from April 29th to April 30th are shown below. So what they want us to do is they want us to record the cash receipts on April 29th and April 30th in a general journal. Okay, so what I'm going to do here is I'm going to just make room so that we can record this right here on our sheet. Okay. Okay, this is going to be our general journal. Okay, so this is going to be at April 29th. All right, and it says cash sales per the cash register tape were $1,526. The cash count is $1,817. Okay, so we need to figure out if there's a cash short or a cash over. Okay, so what I'm going to do is we're going to make this a little different. We're going to need our journal, as well as we're going to need an area to work out the amount. So I'm going to add a little area here so we can do that work there. Okay, so we're going to first start off with our cash. In this journal entry, we started off with our cash count. So what I'm going to do is I'm going to just go ahead and select this so we don't drag on with this video. Okay, so we're going to start with our cash count. And our cash count, what we counted, is going to be the 1817. Okay, and the change, what we keep in the change fund is going to be the 300, which was given to us in the introductory paragraph. Okay, and then so our bank deposit is going to be the 1800 minus the 1817 minus the $300. Okay, so that brings us to, let me do the calculation. We're going to take the 1817 minus 300, and that equals 1517. Okay. Okay, so that's going to be the amount of our bank deposit, or in parentheses, I'll put here, that's going to be the amount of our sales that we're going to record in our journal entry. Okay, so our sales per our register tape. So now we're looking at, what did our register tape say we had? Okay, so the register tape says that the cash receipts register tape says 1526. Okay, so we want to go here. Bring that back. Perfect. So we want to go here and we want to record the 1526. Okay, and so what we're going to do is take the difference. So 1517 and 1526. So right now we're seeing that 1517 is less than 1526. So we're short in our register. Okay. So we're going to consider this as short. Okay, we're short. And we're short by how much? So we take the 1526 minus the 1517, says that we're short by $9. Okay, so that's what our journal entry is going to be for. $9 to help us to balance out for this journal entry, for this register. Okay, so on April 29th, we're going to go and we're going to prepare the journal entry, right? And so since we were cash short, when we're cash short, what do we need to do? We need to debit, correct? Okay, so we're going to start off with our cash, and our cash is going to be a debit. So I'll just put a DR in front of it. Debit our cash. And we're going to debit our cash for the amount of the bank deposit, which is 1517. Okay, and then we're going to go and we're going to debit Okay, just 1 second. I may be confused just a little bit. Okay, so we're good. It happens sometimes. So we're going to be debiting our cash short or over for the $9. Okay, and then we're going to go and we've brought in cash, we brought in revenue, so we need to credit our revenue, and our revenue is our sales. A credit to our sales is going to increase our sales. All right, and that's going to be for the amount of the register tape, which is 1526. All right, and we can put in the memo. To record sales, or we'll say cash receipts, and cash short. Okay. So now we're going to look at situation number 2. Our sales receipts the cash we received on April 30th. Okay, let me just label this as April 29th. Okay, so now we're going to be at April 30th. Okay, so we're going to do the same format for this one as well. We don't need all of that bolded. So our cash count, it says our cash count is the 1735. And we see that here in our problem, in our example. Okay, so in our cash count, we're going to change this to 1735. Okay, and our change fund is still $300. So our bank deposit amount is going to be the 735 minus the 300, which gives us 1435. Okay, so I just did the math. Is 1735 minus the 300 gives us 1435. Okay, and then in our register, it says our register tape said 1434. Okay, so the difference between those two is going to be $1. All right, so on our register tape it says we only have sales of 1434. However, our bank deposit amount, when we counted the cash in the register minus the change fund, it was 435. So we have more cash in our register than the tape. So that means our cash is over. Okay, and when we're over, we're going to debit. We're going to credit, sorry. So another point I want to make, this isn't going to be my sales. I want to make that correction. So make that correction in your notes as well. The amount of your sales is going to be what is shown on your register tape. Okay. So it says sales here. We'll just put this in parentheses. So you understand this is what we're going to record as sales in our journal entry. And all the time, every time, this is going to be our credit. We credit sales in order to increase sales. Okay, so I do want to just make that adjustment and that correction. Okay. So we have $1 over. So we're going to go and make that journal entry. And this journal entry is going to be as of April 30th, just as it says in the example. Okay, so we're going to say April 30th. And we're going to go and we're going to debit our cash. And our cash was $14.35. And I'm getting that here from the bank deposit. All right, and then we're going to go and we're going to credit our cash short or over. For the $1. Okay, so that'll be for $1. Then we're going to go and credit our sales for the amount of the sales. It says here, sales is 1434. Okay, so this helps our journal entry to balance. We have the addition of the two of these is 1435, and we debited our cash for 1435. So that's how we'd go about preparing journal entries to correct our cash, okay, to reconcile our cash. So you can always go back, rewind the video, and get a better understanding of that if I went a little too fast. So now let's move on. This is on cash received on accounts, meaning our customer used a credit card or they used a some type of credit card from, maybe it could be from directly from the store, a Kohl's card or a Home Depot or a Macy's card, or sometimes they'll even use American Express, Discover, Capital One, those types of bank cards they would use to make a payment instead. So generally a business makes sales on account and bills the customer once a specific period. So like say a month, okay? So that's if you're giving them an invoice or a sales receipt. All right. It sends a statement of account that shows the transactions during the month and the balance owed. All right. And that's what they're going to do if they're providing credit to the customer from their particular business itself. Okay. Then checks from credit customers are journalized and posted like we did in chapter 7. And then the checks are going to be deposited in the bank. All right. So those are other types of ways that we're going to receive cash for those customers that are on account. Next, we're looking at a promissory note. And a promissory note is like a promise to pay. And it's a written promise to pay a specific amount of money on a certain date. All right. And so the promissory note is going to tell you specifically how much interest the note has, and it's going to be used most times for businesses to extend credit. Okay, so say you provided a customer with credit and they weren't able to meet that credit obligation in time. Maybe you can extend their credit longer by putting it into a promissory note and making them pay interest on the note. Okay, so that you are getting some future benefit for allowing them that extra time to make payment on the note. All right, so you see here it says it's also used to replace accounts receivable balances when an account is overdue. All right, and so here you see it'll tell you the period of the promissory note. It'll tell you who is paid to the order of. It'll say that it's payable at Texas Bank. And so when this customer goes and makes this payment, they can take it directly to the bank. Okay, there are those options where customers can take it directly to the bank, make the payment with the interest. Okay, and so this particular note has a 9% interest. All right. And so it's a 6-month note. The note happened July 31st, and it's going to be due January 31st, okay, of the following year. All right. So we're going to keep moving forward. So when we're recording a promissory note in General Journal, so this is going to be an example. So on July 31st, Max Out Sporting Goods recorded a General Journal entry to increase notes receivable and to decrease accounts receivable for $800. All right. So the journal entry, we would record the notes receivable for the total amount of $800. All right, so what we would be doing here is we're taking it off of the accounts receivable of Steve Fisher. Right now, he has accounts receivable. He can't make the payment in time, so we want to give him extra time to make this payment. So we issue him a note, and it's a 6-month note, and it's going to carry a 9% interest. So we're going to have some interest we're going to receive at some point in time in 6 months, preferably when he makes payment on this note. So we're going to move it, his account. We're going to take it off of our receivables by crediting our receivables, and we're going to create this note receivables by debiting our notes receivable for that particular account. Okay, so that's what you see going on in this on this slide here. Okay, so then once we record the payment of the note, we're going to be debiting our cash, okay? And then we're going to be crediting the interest income and the notes receivable. All right. And so how this is came about is at the end of the note period, we'll have to compute the interest, okay? And most times the banks will do this and tell them exactly how much they need to pay, all right, in interest. And so the interest on this particular note is going to be $36. And that interest rate is at 9% per year. Okay, so it's going to be 9% per year. We have to take into effect that this promissory note is not going to be for 12 months, for the whole 12 months. It's only for 6 months. All right, so we have to take the correct rate amount. So you see here, they're taking the 9%, but only at a rate of 6 months. So that decreases it to 4.5%. So then I'm going to go and I'm going to take my total amount of the note, okay, and I'm going to times it times the 4.5%, and that's going to give me $36 in interest that this customer, Steve Fisher, must pay. All right, so the amount with the interest is going to be $836. So most times I'm not going to see this note going in until I get my bank statement. So when I receive my bank statement and I see this amount and it's like 836, I have to remember and know where this note came from. There will be a description that kind of tells you received cash and it was a note or some type of deposit, and you would just go and you would record the journal entry for that notes receivable. And you do that by debiting your cash for the total amount of the 836, which was deposited into the bank. But then you would go and you would credit your interest income and you would credit the notes receivable. Okay, so that just takes it off of the notes receivable. This isn't going to be any sales or anything. We've already recorded it in our sales. We just didn't receive our cash in time, so we moved it over to a notes receivable. Kind of like our accounts receivable. It's just a note now. Their notes receivable and accounts receivable are both assets, okay? We credit them to decrease it. So I'm crediting my notes receivable to decrease it because now I've received my cash. So I don't want that amount sitting on my notes receivable. Okay, so that's why we're making that entry. And so the memo says payment for Steve Fisher on a note dated July 31st, 2020. Okay. So moving along, now we're looking at the petty cash fund. Okay, so every company is going to have a set of cash set aside within the company. Somewhere in the company, there's going to be a petty cash clerk. And that person is going to keep petty cash available for small things. Okay, small things could be like postages or supplies, or maybe the boss said, yeah, let's bring donuts and coffee in for our workers. So it's going to be small things like that that we don't want to go do a invoice for or take up that long out drag process to get the cash and get the check. So in those cases, we would just go to the petty cash fund and we'd get the funds we need in order to pay for whatever that small expense was. All right, so this slide kind of goes over that, and this is the journal entry that we're gonna use in order to establish our petty cash fund. We're not gonna just automatically have a petty cash fund. We do need to do a journal entry. Okay, and petty cash is still gonna be considered an asset, so we're gonna be debiting it in order to increase it. Okay, and then when we take the cash out of the bank, obviously we do need to credit our cash. Okay, because our cash in the bank did go down because now that cash is readily available within the business. All right. So there's going to be a cashier that's going to be responsible for the petty cash, a cashier or a petty cash clerk, someone that's responsible. All right. And the amount of the petty cash fund is going to depend upon the need of the business. Most petty cash will be about 500 at the most. I say 300 to 500 at the most, okay? So you don't just get to go to the cashier and just ask for petty cash. There is a process, okay? And this process is going to be for internal controls. All right, so we're going to keep moving on. So this is a petty cash voucher, okay? It's going to be a pre-numbered voucher, and it's going to be used to increase good internal control, all right? This amount is recorded, and the purpose of the fund is listed, okay? So why do we need this cash? So is for office supplies on this particular voucher, all right? And the account needs to be debited and written along with an account number. Okay, so we'll say that we're going to debit our supplies and the amount is going to be 625. All right, and then we'd have to get a signature and then we'd have to get approval. So the signature is going to be whoever's requesting the cash. They're going to sign it. They're going to say what it's for. And then we're going to get an approval as well. Okay. So those are all internal control processes so that we're not just handing out cash for anything. All right. So finally, that petty cash clerk or petty cat or the cashier is going to keep an analysis sheet. And this analysis sheet is going to be used to look at the receipts and the payments. So when we put cash in there or when we make a payment, and it's going to contain columns such as supplies, freight in, and miscellaneous expenses, the normal types of reasons we would go and get petty cash. All right. And the accounts debit column, there's going to be a debit column. Okay. And in the debit column is going to be for entries that do not fit into the special columns. This is going to just be where we just add whatever, if it were something other than supplies or shipping or any miscellaneous expense, we would just add it to that debit column. And this is just basically used as basically a worksheet to record transactions that are involved in the petty cash for reconciling purposes to make sure everyone internal controls basically to make sure those who did request petty cash, there was a reason why and we're taking note of it. So this is what a petty cash analysis looks like. Okay, it'll have a date, the date we have, the date we requested petty cash, the voucher number we used, what it was for. Okay. So this first line says to establish the fund. Okay. These next lines kind of go over when cash is being issued out. There's a receipts, and our receipts are just going to be whenever we establish the fund. Okay. Then our payments, when we issue payment for those vouchers. Then we'll have our supplies. So we'll say, oh, the 1625 was for supplies, so we'll pull it over to supplies. This $24 was for delivery or freight in. Okay, and then this $25 was drawing. So Pharaoh in this example, I guess this is the owner, and they drew out $25, obviously for personal reasons. Okay, so that's why we have that other accounts debit column. For other accounts, it'll tell you the account title just so you'll know where to go and record that debit. All right, so miscellaneous, we have some window washing that went into miscellaneous. Postage stamps went into miscellaneous. Okay, so then finally we need to replenish our fund whenever it gets too low. And so this just shows you the amount that we need to replenish it. And that's just adding up this amount here, all of the payments, and what do we need to do to replenish our account back. So after all of those payments for February, we only had $15.25 in our petty cash, so we needed to replenish it for the next period, and that's what you see going on here. Okay, and replenishing funds just equals the total payments column. Okay, and this is the journal entry to replenish your petty cash fund. Okay, so when we establish our petty cash fund, we're going to go and debit our petty cash. And for this particular example, their petty cash fund is 350. All right, and then they're going to go and credit their cash for 350. So that establishes the fund. All right, when we want to record expenses and replenish the fund, then we're going to go on any expenses we had, janitorial, miscellaneous, postage. We're just taking the amount of the replenish, okay, and we're going to go and cut a check for it, okay, for $323.16. Okay, and how over here you see it says cash over or short. Okay, so we'd have to take that into account as well. So then here's another one to establish the petty cash fund. We're going to go and we're going to debit our petty cash and credit our cash. This should be indented. Okay, and then anytime we're recording expenses, we're going to record like so. Okay. And then we have our cash. We're going to be issuing cash to replenish the petty cash fund. All right, and then whenever we want to reduce the fund or we don't want to have the fund anymore, we just take the cash back to the bank, deposit it into the bank, and we're going to go debit our cash for the amount of the deposit, and we're going to credit our petty cash. Okay. Or maybe we just decided we only need $300. So in this one, they just reduced the petty cash fund. So these journal entries are all very important. Do take note of them. You will see them in your exams. You will see them in your homework. So when you're recording the establishment of the petty cash fund. So we just went over that kind of. So we'll go ahead and we'll record the journal entry to establish the petty cash fund. And this would be in our general journal. Okay, and this is going to be at January 2nd. So we're going to say January 2nd that we want to establish a petty cash fund. So what we need to do first is we need to debit our petty cash fund, all right, for 370. And then we need to go and credit our cash for 370. Okay, and that helps us to establish our petty cash fund. All right. Alrighty, so that's how we're going to establish our petty cash. And then if we had any expenses, in our step-by-step, I'll go more over expenses, okay? I did provide this journal entry here for expenses, but I do want to go over this a little bit more with the cash over and the cash short calculation so that you can get a better understanding of this cash short and over in the petty cash fund, okay? So that completes this video slide on our slideshow for our cash. On my next video, you can go start on my next video, and we're going to go over the different problems as always so that you can complete your homework successfully. Okay, so I'll see you in the next video.